Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey guys, my name is Mark Eitel and you are listening to the Mr. Mortgage Show. Hey guys, if you have questions or comments as we get the show fired up, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. You can call or text that number anytime, 855-462-7292, or shoot us an email, and you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and shoot over your questions via email, and Jen will read them on the air for you. But guys, it was an action-packed week of data. No surprise with the Federal Reserve's rate hike, at least not to our listeners. If you were surprised by that, then you have not been paying close attention to what we've been talking about on the air or on social media, because this one we saw coming a mile away, even though he had faked everybody and paused last meeting, which I think was super deceptive. I don't know what that was about. But then when he went on to say, in a series of talks after that, that they don't anticipate, or he doesn't anticipate, seeing an easing cycle until 2025, which kind of shoots a lot of the predictions in the foot of rate cuts by the end of this year. Because, guys, the data is just not supporting the opportunity to start easing in the interest rate hikes, because this economy, man, it's crazy. It's like one of those zombie movies. It just won't die. The Consumer Confidence Index came in at 117, up from 110 last month. That's a big number, guys, in the face of all of this inflation, in the face of elevated interest rates. The consumer is just out there spending like a Mad Hatter. And the only hope that the Fed has to cool them off is increasing the cost of money. And you saw them do it again this week. So I think that, coupled with the earnings reports that were released last week, a lot of the big companies made more money than the consensus was, which indicates that consumers are buying products and they're putting people to work. So all of the underlying fundamentals of the economy are supporting the need to continue to hike rates if the goal is truly 2%. I think what got a lot of people wrapped around the axle was the last inflation number that was reported at 3%. Everybody got really excited because we're going down, and 3 is much closer to 2 than 9 is. So they get it. We've got to be down somewhere around the bottom. And then here we go with another rate hike. But guys, that 3% number was super deceiving for a lot of reasons. And the number one reason is that's an annualized number, right? So it's June of 2023 over June of 2022. Well, guys, we're 3% year over year, but June of 2022 was 9.1% over 2021. That was the big, here comes the 80s again, right? Everybody's driving a T-top Camaro, listening to Motley Crue with a mullet haircut and a concert T-shirt on, because we were flashing back to the 80s with that 9.1% inflation number. And that was on top of a 3% number the year before that. It really just indicates that if we're going to get to 2%, we still have some work to do. So it's yet to be determined if he keeps his foot on the brakes all the way to a 2% inflation number, but he's clearly indicated that's his goal. So guys, we weren't surprised by it. I hope you weren't surprised by it. And housing doesn't appear to be bothered by it, because here we go again. May's housing numbers were released with a 0.7% increase month over month, which is the fourth month in a row. And 0.7% doesn't sound sexy until you annualize that out at 8%. Well, wow, what was it? I think 8.4%. I don't have a calculator in front of me. I'm public school educated, so I can't do that math in my head. But nonetheless, over 8% appreciation. Well, guys, this was supposed to be the year that the market crashed. And here we are averaging 8% appreciation based on those numbers that were released. And we talked about it last week. Florida's at 15% year over year. That's nuts, right? We shared the story of that young family who now is priced out because last year's house at 400 is now 460 and interest rates are 7. What's going on? So supply and demand is the only thing that controls pricing. And this is just one more example of how powerful that equation is. The cost of capital is irrelevant. I shared a story once. If you walk into the electronics store and buy the latest, greatest gadget and you reach in your pocket and you pull out a 22% interest rate credit card, or you pull out cash, the price is the same. They don't care how much interest you're paying on the money that you're using to buy it, right? I say it all the time. The cost of the capital does not impact the value of the asset. Supply and demand does. Now, if there's a line of people out the front door who want that gadget, they're not going on sale anytime soon. As a matter of fact, they're going to mark the price up. But if they've got a pallet of them in the back that they can't sell, that's when they're going on sale. So again, keep that in mind. The cost of the capital does not dictate the value of the asset. Only supply and demand does. And the cost of the capital can slow demand, and it is slowing demand, but it is not slowing it to the point that we're outpacing supply because there's not enough supply. There's not enough supply to tip the scales. People don't want to sell their home and cash out that 3% interest rate and go borrow money closer to 7 and pay this lofty price. Most people couldn't afford to buy the home they're in today if they had to borrow money at 7% and pay taxes and insurance based on a new transaction price. Let that sink in for a minute, guys. We're not even talking about move up. We're talking about buy the house you're in right now. So because of that, supply remains pressured, which is supporting housing values. And you hear a lot of talk on the news about the housing affordability crisis. Well, it's only a crisis if you don't already own a home. If you own your home, you're fat and happy. You've got equity, you've got a low interest rate, and the factors that I just mentioned are supporting these current values. And some people are accessing equity and buying investment properties. I mean, we talked about it last week. I guess it was 2 weeks ago. The strategy that we came up with where we're, put your kid's house on layaway was kind of the way I summarized it, where you pull the equity out of the property that you have, the house that you're living in, use it to go buy a rental property, put a renter in there for 10 or 15 years. And when your 10-year-old is 20 or 25, then you can gift them the equity. And now they're out of your basement eating Hot Pockets in their own living room. But more importantly, you've given them a tremendous leg up in life. And you did that by allowing the renter to create the equity for you. And it didn't cost you anything in the grand scheme of things because you traded equity for equity. And you gift the equity to your child in 10 or 15 years. So if anybody wants to talk about that, we're getting a lot of interest in that as an idea, and I find that super, super exciting. So anyway, guys, I just encourage everybody to look for the opportunity. Guys, I'm not blindly optimistic. I'm not rosy sunshine over here. I'm just not seeing the big housing crash setting itself up that everybody's been talking about. And we can dive into it. It's a very different market than '08. I was here then. It feels the same, but the fundamentals are different. And there's just not the teeter-totter at the moment that everybody's been anticipating. So guys, you hear the music? I'm anticipating a break. We'll be right back after this very short break to continue the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. Jen is womanning the Anytime Hotline, and she will get you on the air. Again, call or text that number, 855-462-7292, or just visit mrmortgageradio.com. mrmortgageradio.com. Scroll to the bottom of the page, click the email icon, and you can send her your questions via email, and she'll read them on the air for you. But hey, speaking of Jen and your questions, we've already got a few lined up back there. I think the natives are restless today. There's a lot of confusion and a lot of questions around what is going on. I thought the Federal Reserve was done raising rates, and here we go again. Guys, I'm happy to deep dive that or any specific mortgage questions that you have. Our goal is to give you the tips, the tricks, the strategies, the answers to your questions, and all the info that you need so you can make better real estate and mortgage decisions for you and your family. So let's throw it over to Jen and get to the questions right now. Go ahead, Jen.
Jerry sent us an email. How much are we typically able to borrow with a reverse mortgage? We don't have a mortgage now.
Hey, Jerry, that is a great question. We get it often. Everybody wants to know how much equity I can access. Is this even worth the effort? So sadly, there's not a hard and fast rule. The things that dictate how much equity you can access are your age, right? The interest rate, and obviously the value of the property, and are there any liens? But you mentioned there's no current mortgage on the property. So there is a rule of thumb. It's typically around 50%, but I say that cautiously because it could be 45%. It could be 55%. It all has to do with your age and the current interest rates for the reverse mortgage. If you have a $500,000 house, you're looking at somewhere around $250,000, and the closing costs associated with the reverse would be taken out of that. And then, of course, whatever mortgage, first, second, or any liens that are on the property would have to be paid out of that as well. And then the rest would be available to you in the form of an equity line. Essentially, it's like a credit line. It's actually earning interest for you, though, or you can receive monthly payments or one lump sum or a combination of that. So typically somewhere around 50% is going to be where you'll land. But I encourage you to visit mrmortgageradio.com and click that more about reverse link, and we can start the dialogue. And I'm happy to run very specific numbers for you. I don't have to pull your credit. I just need the property address. I need to know if there's a current mortgage on the property, and then your birth date. I don't need a social, though. I don't have to pull your credit, to give you a much better idea of how much equity would be available to you. And I'm happy to do that for you if you'd like. So great question. And guys, we're talking to more and more people about reverse mortgages. And I'm not going to go into my personal journey down the reverse mortgage road. I got involved because of a family member. But man, it's an amazing product for the right person. But it's just a tool. And I say it all the time. It's not a tool for every job, right? It's a hammer. You can build a house with a hammer, but you can tear a house down with a hammer. So the reverse mortgage is a fantastic tool for the right person in the right scenario, and it can change your life significantly for the better. And I love these conversations. So I encourage you to visit mrmortgageradio.com, hit that more about reverse link, and then let me do the calculation for you. But I appreciate it. Hey, Jen, do you have another question?
Valerie sent us this. I was on the FSBOzilla website but can't download the book. Is it possible to download it on my Kindle?
I wish. You know what, Valerie? You just gave me an idea. I'm going to submit the book to Amazon and see if that's Kindle is Amazon, right? Yeah. Anyway, great question. There should be a red bar underneath the book reader because it's a flip book online, right? So go to the flip book page and there's a big red bar. If you click that red bar, you can put your email address in there and they'll send you the book as a PDF, and you might be able to transfer that file over to your Kindle reader if you prefer. but they'll also send you the 4 do-it-yourself guides. One is on how to take awesome listing photography with just your cell phone camera. And I'm sure there's a photographer out there saying, yeah, it's not going to be as good as mine. I get it, but you can get a great photograph out of a cell phone camera. It's certainly not as good as a pro, but you can definitely get the job done. There's a guide on how to do it. There's a guide on the recommended little fixes and touch-ups a lot of people overlook that come back later in a home inspection. That's a second guide. There's a guide on staging and decluttering, and then one on creating the curb appeal. That'll make a big impact. So you'll get the book and the 4 do-it-yourself guides if you go to FisboZilla and click on the red bar. And guys, if you're out there curious, if this is the first you're hearing of it, not too long ago we launched this program to help for sale by owners, FSBO, often referred to as Fisbo, and then I just threw the Zilla in there because I like the Godzilla monster, and the title of the book is FisboZilla, the Commission Killer, because a lot of people are going the for sale by owner route and foregoing that big commission. And at these sales prices, man, these are real numbers. We talked about the average salary in this country was somewhere around $55,000. Well, on a $500,000 property, you could pay upwards of $30,000 in commission. That's a half a year's salary for somebody. So it's the do-it-yourself route's not right for everybody. But if you are inclined to give it a shot, that FisboZilla resource was created for you. No cost, no obligation. It's out there. Check it out. Let us know what you think. You can find the link to that at mrmortgageradio.com. But Valerie, thank you for that question. I hope that helps, and maybe that's the way to get it over to your Kindle. But I appreciate it. We've had an overwhelming response to that FisboZilla program, guys. And I'm not anti-agent. I'm proud to be part of the Really Great Agents Network. But paying a real estate agent's not in the cards for everybody, and a lot of people attempt the for sale by owner route themselves, and we're trying to set you up for success. And I get this question often, what's the catch? Guys, the only catch is I want to be the mortgage guy. I want to pre-approve as many people as possible who are interested in your property, so you've got a rock-solid approval and your transaction is going to close and you can move on with your life. And I selfishly get the opportunity to meet people who need my mortgage services, because as much as I love doing the radio show, we are a mortgage team and we get paid to originate mortgages. So I hope that gets that out of the way. But that's it. There's no hook. There's no catch. That's all there is to it. But guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, keep your questions coming. 855-462-7292 is the Anytime Hotline. 855-462-7292. You can call or text that number. Jen is womanning the hotline, and she'll get you on the air. 855-462-7292. Or just shoot us an email. You can do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click the email icon, and you can shoot her your questions that way. She'll read them on the air for you. But guys, let's keep your questions rolling. That's always my favorite part of the show, and I know we've got a few stacked up back there, so let's try to get through a few here. What do you have, Jen?
Mary is asking, I want to start buying rental properties. Are there mortgages for first-time investors?
Hey, Mary, that's a great question. Another place a lot of people are using all of this newfound equity wealth is buying investment properties. So to answer your question, yes, there are many, many programs available to first-time investors. One of them is the landlord loan. You hear me talk about that one so often because it's one of the more popular loans when buying rental property because your personal income is not underwritten. We're looking at your credit, we're looking at your assets, and we're looking at the income produced by the property. As long as the property supports the debt load, you're off and running. So that landlord loan has the availability to be utilized as a first-time investor. So I hope that helps. And we talked about it I think it was last week, maybe the week before. We had come up with a strategy and it was based on a conversation I had with a friend of mine who was super concerned that his young child was not going to be able to purchase his first home based on his scholastic interests and where he's likely going to land in the professional world. By the time he's ready to buy a house, unless the world comes to an end, he's most likely not going to be able to pull the trigger. So we came up with this idea, and I kind of had this cutesy name where you're putting your child's first home on layaway, right? Because I think of everything in pictures. I'm very simple, born and raised in Florida, simple guy thinking pictures. So that layaway idea made sense to me. And we talked about pulling some of the equity out of your property and going and buying an investment property. And what brought that to mind was the landlord loan is a great tool to utilize for that. And then renting the property for, I don't know, say 10 years. 15 years. I don't know how young your child is and where you would start in this cycle, but think this one through for a minute. You're trading equity in your current home, or some of it anyway, not all of it, for equity in a rental property. You put a tenant in there, let the positive cash flow pay down the principal and even make some money. You have the write-off benefits of owning the rental property. There's benefits to owning it in addition to just the cash flow, but more importantly, you're owning it at today's prices. So in 10 or 15 years, when your child's ready to strike out on their own and make their way in life, you can sell that property to them with a gift of equity, pull some money back out of it so you're made whole, and they're off and running with a great, great head start in life, and they didn't have to go out there and fend for themselves and find that first home and save for 5 or 10 years to get a down payment together. And if someone's trying to do that in this market today, they're being outpriced by appreciation and by the cost of money. Imagine if you would have done that for your child 10 or 15 years ago, how much equity they and you would have in that property today. So the landlord loan is a very, very powerful tool, and all of the newfound equity people have are making them think a little bit outside the box in trying to come up with ways to maximize that current equity position to create additional opportunities. So I know I went long on that, but I wanted to throw that in there because we are seeing that utilized for that reason as well. Hey, Jen, throw me another question.
Sandra sent this one. We've been wrestling with the idea of getting a reverse mortgage. I'm concerned about leaving my children with a bunch of debt. What happens if they can't pay it back?
Hey, Sandra, that is a great, great, great question. A lot of people have this concern, and it's mainly driven by the idea of what happens if I owe more than it's worth when the kids inherit the property. Because from the standpoint of just inheriting it with equity, so they would have to pay it off like any other mortgage. It would be satisfied by either refinancing it or selling it, and your children would get the equity, just like a normal mortgage. I can't stress that enough. But here's the part that confuses a lot of people, and I'm not sure if this is what you're asking, but I want to touch on it. What happens if you owe more than the property's worth when you die and you leave the property to your kids? Are they then stuck with the debt burden? Do they have to satisfy the negative equity position? The answer to that is no. It's a federally insured loan program, and they can slide the keys across the desk to the bank, and the bank deals with it. It's a federally insured loan program administered through FHA. you buy a mortgage insurance policy as part of the closing costs, and that prevents a negative equity position being passed down to your children. And that applies if you have a lot of other assets as well. You're not going to have to sell this to pay that. The reverse mortgage itself is non-recourse in that sense. So I hope that answers that question. And guys, we are talking to more and more people about reverse mortgages, primarily, as I mentioned earlier in the show, because the fixed income senior is just drowning in all this inflation. And if that's you and you want more information, go to mrmortgageradio.com and click on the More About Reverse button, and you can start the dialogue there. There's a short video. You can request the booklet. It's no pressure, no obligation. We are happy to have the conversation with you. Guys, if you've heard my story, I got involved in the reverse mortgage space because my mother was considering a reverse mortgage, and I wanted to learn everything I could about it. And I dove headfirst into it and got certified in the space. And I love the loan product, but it's not right for everybody, and it's certainly not right at every time. So let's have a conversation if you're truly considering it. Hey, Jen, throw me another question.
Tony is asking, if we use the rec refinance to pay off our credit cards at the closing, are we able to keep the cards or do they get closed out?
You're one of those consumers that make up that 117 index this month, right? You're ready to go spend again. No, sir, you do not have to close those out. You can keep those accounts open. Guys, what Tony's talking about is the rec refinance allows you to qualify for your refinance based on your future reduced debt to income after you pay the credit cards off. Unlike a home equity line of credit, we're talking to more and more people who don't qualify for the equity line because of their debt load. And we're able to say, okay, we're going to pay off the Discover, we're going to pay off the Visa, and we're going to pay the car payment off at closing. Then we can subtract all of that debt from your debt to income ratio. You now qualify. The caveat is it does have to be paid at closing. But Tony, to answer your question, you do not have to close those accounts out. I hope that answers the question. Keep them in the freezer, though. Be very careful not to run them back up. But hey, guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to mrmortgageradio.com. That's mrmortgageradio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. And I know we got some questions backed up there, so we are going to rip through a rapid round of questions. But hey, if you've got questions or comments and you want to squeeze them in, 855-462-7292 is the Anytime Hotline, 855-462-7292. You can call or text that number, or shoot us an email, and you can do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and Jen will get your questions on the air. But hey, speaking of Jen, let me throw it her way and keep this thing moving. Jen, what do you got?
Max sent us this. Why do you think a permanent rate buy down is better than a 3-year buy down? Doesn't it make sense to save more now and refi later?
Hey, Max, that's a great question. On the surface, it's an easy answer. Yes. If you know rates are going to go back down. So let's talk this through, because I had this conversation a lot last year. About this time, we were creeping up towards 7%. And we clipped 7%. And people were talking about a temporary rate buy down. I'm going to buy the rate down. In a 3-2-1 buy down that Max is talking about, you buy the interest rate down 3% the first year, 2% the second, 1% the third, and then it resets to where it started. And it acts a little bit like an adjustable rate mortgage, but it's a completely different animal, because once it's back, it stays there. It's a, fixed rate, fully amortized loan. So don't get the two confused, but they do feel a lot alike. Here's my thing, Max. What if rates don't go back down? And then now you're stuck with a 7% interest rate when maybe you could have negotiated with the seller for some help on the buy down and gotten a rate of 6%. Or maybe you got lucky and you caught it on the right day and you got 5.875%, right? Now you don't care what happens to interest rates in the future. If they go back down to 4, great, you can refi. But what if they go to 8? What if they go to 9? You're sitting down in the high 5s or the low 6s, way, way ahead of the game. So I'm not arguing against your logic. I totally understand it. And if you know rates are going to come back down, if you know something that's certain, it's a great strategy. I'm just super conservative because of what I saw happen in the market with payment shock. And what I mean by payment shock is, even though you qualify for the mortgage at, let's say at 7%, and you use the 3-2-1 buy down, which means year one, your interest rate is 4%. Man, that's super attractive. But human nature says, okay, I can afford a jet ski. I can afford a small RV. I'll get it paid off in the first 3 years. Well, next year, your interest rate's 5. And then it goes to 6, and then it goes to 7. And now you're in a position where, like the previous caller, you're doing a rec refi to bail yourself out because you thought interest rates were going to go back down. I'm not saying they're not. I'm not of the mind that they're going to go down to 4, and I'm not of the mind that they're going down as far or as quickly as people think. So it's not a bad idea if your strategy is short term, or if you've got a different level of certainty about where rates are going to be. But brilliant question. I'd love to talk it through with you if you're open to that. Just call or shoot me a text. We'll set up a time to jump on the phone. But I appreciate that one, Max. Thank you for shooting that over. Hey, Jen, throw me another question.
Rich sent us an email. Can I use my VA loan to buy a $1.3 million home in Jacksonville, Florida? Is this still a 0 down payment loan?
Hey, Rich, brilliant question, my man. The answer to that is yes and yes. So a lot of people assume there's a cap on how much you can borrow. We have a wholesale channel that allows us to go to 3 million and another that allows us to go to 5. Now, those change from time to time, but right now you can get up to 3 million pretty regularly. 100% financing, VA rates. It's a wonderful option. Now, there is a funding fee unless you're disabled, but there's no mortgage insurance with the VA loan, and you are able to borrow, in this case, $1.3 million on a $1.3 million purchase, which makes it super attractive when you price the VA loan against a jumbo loan. The VA's winning hands down. So assuming that you qualify for the loan, you can be fully underwritten for the loan from a DTI standpoint. There's no restrictions that are going to prevent you from buying a $1.3 million house. So I hope that helps. And if you need more information, please reach out to us. Thank you, sir. Hey, Jen, toss me another question.
Mickey sent us this. Do you think a HELOC is a better option for debt consolidation if we have a mortgage rate at 4.125%?
Hey, this one is a fantastic question. And there are so many what ifs around it that it's not an easy answer. But on the surface, it makes perfect sense to preserve your low interest rate if you can. But just know that your HELOC is adjustable, right? So even if it has an attractive introductory period, the Fed just moved interest rates again, and he may move again. Who knows? So that HELOC rate is going to start higher, and it may go even higher from here. Now, with that being said, if the Fed starts to cut rates, that HELOC is going to go down. So to be fair, it can go up or down. But if you're going to go that route, make sure you put a strategy in place to pay that off, because it's a higher rate and you don't want that thing to linger around for 10 or 15 years. Most HELOCs after 10 years, they'll convert to a 10 or 20 year loan and you won't be able to draw down against it. But I'm not anti-HELOC. I love the idea of having a HELOC even if you don't need it and just kind of putting it on the shelf for rainy day money. But it's a tough one to just answer without knowing all the details. And I mentioned it earlier, that the one caller a few callers ago about the rec refi. Some people don't qualify for the HELOC because of their debt to income ratio, and then it's not an option. You're doing the rec refi to reduce, eliminate, and consolidate the debt. So brilliant question. I would need a little more information to give you an answer I'm more comfortable with, but Google blended rate calculator, and type in how much money you're going to borrow on the HELOC, what the interest rate is on the HELOC, your current mortgage and your current mortgage interest rate, and it will give you a blended rate. So you're looking at your actual cost of debt each month, and that might help you make the decision. But it's a brilliant question, and I'm open to a discussion if you are interested in deep diving that one. So, all right, come on, Jen, throw me another one.
Candace is asking, we're ready to move, but want to make sure we have somewhere to go. Can we use an equity loan as a down payment on our new house? We'd like to buy the new house first.
Hey, another great question. You can, absolutely you can. An equity loan, you said. So that's a great way to do it. But here's the thing. If you go that route, it's called a bridge loan in most instances. And you can arrange the bridge loan through the same mortgage lender. We do it. That will be the mortgage company on the new purchase, right? So they're setting both of those up for you. Now, here's the one thing to consider. Your debt calculations are going to be based on your current mortgage, on your bridge loan, and your new mortgage, because there's no guarantee and timeline that you're going to sell that property. And then it does need to be sold within 6, 12, or 18 months. There's different categories of how the bridge is structured, and that prevents you from then keeping the current property as a rental. But brilliant question. The other thing to consider is a delayed closing or a post-closing occupancy on your current property. So you could essentially say, okay, I'm going to sell you my house. We'll sign a contract. We're going to close in 90 days. And then you're going to allow me to stay after closing, post-closing occupancy, for 2 months. So now you've given yourself a 5-month window to find and close on the new property. So that might be extreme. Somebody might not be willing to give you 90 days. Maybe they'll give you 30 and then 60. But my point is, those are workarounds if qualifying for all 3 of those mortgages at the same time is difficult for you. But I'm a big fan of post-closing occupancy. And in this tight inventory market, you've got a really good chance of negotiating that. So anyway, guys, you hear the music. You know what that means. That is my cue. We'll be back in a few. Sit tight. On the other side of this very short break, we'll be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, you have offered up some awesome questions. Let's keep them coming. 855-462-7292. That's the Anytime Hotline. Call or text 855-462-7292, or shoot us an email by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. Click that email icon and you can shoot your questions to us via email. But speaking of questions, I'm going to toss it right over to Jen and we'll keep your questions rolling.
Natalie sent us this one. Just want to publicly thank you. I called last week with an old roof and canceled insurance. Anyway, your team is awesome. We've got the insurance figured out and we started the refinance. You guys are the real deal. Thanks. Thank you, Natalie.
Yes, thank you, Natalie. I'm so glad we were able to get that sorted. And that builder's risk insurance policy, a lot of people don't understand it. And in this instance, guys, just to refresh your memory, or maybe you missed the conversation with Natalie, she was canceled by her insurance company, could not get a new policy because of the roof, but couldn't get a roof without doing a cash out refi, but couldn't qualify for the refi without insurance on the property. So we are doing a builder's risk policy. Not us, our insurance referral partners are doing a builder's risk policy to insure the property during the building or during the construction period for the new roof, which enables them to put the homeowner's insurance on the property now so we can close the refi and get her the money to do the roof. So thank you for that, Natalie. Thank you for the public accolades, and we are super happy that we were able to help you. Thanks for that. Hey, Jen, throw me another question.
Michael sent this one. I went to the FSBOzilla site and requested the book, but honestly, I'll never read it. Can you give me a quick idea of how this works? I will be selling without an agent, and I'm trying to figure out your program.
Hey,
Thank you for your honesty, Michael.
Yes, thank you for your honesty. Man, I've got a whole bookshelf of books that I will definitely read one day, but I get all excited. I buy the book. It arrives. It looks more like a doorstop or Atlas Shrugged than I thought it was. And I'm like, oh, I'm not going to get through all of this. Let me put it up there and wait. So, hey, I appreciate you giving us a shot at least answering your question. So, guys, FSBOzilla is super, super easy. It's very, very simple. I wrote a book called FSBOzilla, the Commission Killer, which it's not a novel. It's more like a guide, if you will, but it's all of the common problems people run into when going for sale by owner and workarounds. And we did that to help people through this process. But what we're offering to do is essentially be your pre-approved lender, if you will. And we'll field the phone calls and make sure everybody is approved. And we do that quite simply by asking the hard questions to the person who's inquiring about the property. And if they're already approved with another lender, that's fine. There's zero conflict in that. We do ask them to shoot over their approval so we can review it and make sure that it is truly a DU or LP approval. And I'm not going to bore you with all of the differences, but it's hugely different if you're in contract with somebody that you've got the most solid approval possible. And if they are, we bless it and congratulate them, and you show them the property, and hopefully they buy the house. If they don't, we want to pre-approve everybody else who calls so you know that this is a rock-solid buyer who can close. But here's the cool thing. You don't have to show your property to anybody who's not approved. You already have alleviated that. And then we've got all kinds of strategies that we've built into the program where you show your property for a 2-hour window once a week to pre-scheduled approved buyers only. There's a ton of stuff that we've put together to make your life easier. And guys, the reason we're doing this, it's not charity. I get to meet people who need mortgages, and that's my business. So I'm happy to help. My team is happy to help because we want to pre-approve as many people as possible. So Michael, that's the program in a nutshell. We've put together many, many other resources. I mentioned the guides earlier. There are title companies, title attorneys, transaction coordinators, home inspectors, value report. We'll run a value report for you so you know what your property is likely to appraise for, so you ensure that it's priced correctly. So, Michael, give me a shout after the show, or Jen, if we have, okay, I'll shoot you back a quick email and then we can jump on the phone together, or do it via email. I'll answer any additional questions that you have. I want to keep it rolling, though. Thank you for that one, Michael, and thank you for your honesty.
Meredith has a question. What happens in a reverse mortgage to our unused equity line if property values decline?
Hey, Meredith, that's a great question. It's your money. It's not really an equity line. I call it an equity line because you draw against it as you need it. But once you close the loan, that's your money. So if property values go down, the bank's not happy, but you're fine. That's your money. They can't take it away from you. So brilliant question, though. I appreciate that one. Jen, throw me another question.
Hope wants to know. I've accepted a new job and wanted to take a month off before starting, but my brother told me a gap in my work history will be a problem when I try to buy next year. Is this true? How long can I take off? Thanks.
Hey, Hope. Brilliant question. And your brother is not incorrect. It could be a problem. So let's stick with FHA for a minute, because I don't know what program you would apply for, because they all have slightly different requirements. But with FHA, you'll need to be on the new job for at least 6 months before you apply. Then you would have to have 2 years work history prior to the gap. So if you've got 2 years uninterrupted work history and you want to take 30 days and you're not going to apply for a mortgage until you're 6 months at the new job, then based on the guidelines, you should be okay, if that makes sense. If there are other employment gaps that require additional explanations, then I would need to know that. But if you've got 2 years of consistent history, a 30-day gap, 6 months on the new job, and then you apply, as far as FHA guidelines are concerned, you should be fine. So hope that helps. Thank your brother for giving you some good advice. All right, Jen, throw me another question.
Dennis just sent this. Okay, so your idea about buying a rental and then gifting it to my son later made a lot of sense to me. How does the gifting of equity work? Will I be able to pull some money out when I gift it to him?
So this is a great question. And man, I'm excited that you were paying attention. So to answer your question, yes, you can pull some money back out when you sell the property to him. You don't have to gift him all of the equity, is what I'm saying. So you as the seller can gift him just enough to get him qualified, and then you can pocket the rest in the form of capital gains. So to answer your question, yes, you can definitely pull some money out for yourself. So I hope that helps, and I would welcome the opportunity to talk about this in length. If you're seriously considering it, I'm happy to help any way I can. And thank you again for the question. I'm super excited that this made sense, because I think this is an opportunity for people to capitalize on their newfound equity and set their kids up for success instead of watching them struggle later. And let's say your kid is never ready to buy. What's the worst that happens? You've got a rental property that's performed hopefully well for the last 10 or 15 years. So brilliant question. And guys, this strategy is getting attention because home values are very, very sticky, even in the face of these interest rates. And parents and grandparents are super concerned with how their kids are going to get, or grandkids are going to get started in that very first house. So appreciate that one. But guys, you hear the music, you know what that means? Man, oh man, we have wrapped up another week right here at the Mr. Mortgage Show. Guys, if you need us during the week, MrMortgageRadio.com, MrMortgageRadio.com. Everything's there, from the Facebook page to the reverse mortgage stuff to FSBOzilla, everything. MrMortgageRadio.com. All right, guys, have an awesome week. Jen and I will be back next week right here. Same bat time, same bat station. Be good.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.